Imagine unlocking a vault within your own home, a vault that empowers you to borrow from yourself to invest, grow, and expand your financial portfolio. That vault? It's called Home Equity Line of Credit, or HELOC. And here's the real game changer. This isn't just about loans or emergency funds. It's about strategically leveraging what you already own to fuel your investments and propel your financial growth. But as enticing as it sounds to have your own bank right under your roof, navigating the waters of a HELOC requires wisdom, foresight, and a solid strategy. Finance first, freedom follow. Welcome back to Think Freedom. Today, we'll delve into how a HELOC can become your most powerful financial ally, allowing you to invest more, expand your portfolio, and essentially create a bank out of your own home. We're breaking down everything you need to know to master your home equity and make it work for you. This isn't just finance. It's the art of growing wealth with wisdom. What is a HELOC? So you've heard the term HELOC thrown around in financial circles, seen it in headlines, or maybe it's come up in conversations with savvy friends. But what exactly is a HELOC? Let's break it down. HELOC stands for Home Equity Line of Credit. Think of it as a credit card, but instead of buying now and paying later with potentially high interest, you're borrowing against the equity in your home. Yes, that's right, the part of your home you actually own. Equity is the difference between your home's current market value and the amount you owe on your mortgage. For example, if your home is valued at $300,000 and you owe $200,000 on your mortgage, you have $100,000 in equity. A HELOC taps into this equity, giving you access to a flexible credit line. It's like having a financial safety net or opportunity fund that's tied to your home's value. You can borrow up to a certain limit, repay, and borrow again. Borrowers can usually get up to 85% of their home's equity. In our example, if you have $100,000 in equity, then you can potentially get an $85,000 home equity line of credit. The final number depends on several factors like banks, your income, credit scores, and the type of properties. Most banks offer HELOCs on primary residence only. However, some regional banks or credit unions can do HELOCs on investment properties or even on your whole rental portfolio. Here's where it gets interesting. HELOCs have two phases: the draw period and the repayment period. During the draw period, which usually lasts about 10 years, you can borrow money, pay it back, and borrow again, only paying interest on what you borrow. And about those interest rates, they're typically lower than credit cards because your loan is secured by your home. But there's a twist. The rates are variable, meaning they can change over time based on market conditions. After the draw period comes the repayment period. Now you can't borrow anymore and you begin to pay back the principal amount borrowed plus interest. This period can significantly change your monthly payments, especially if you borrowed heavily during the draw period. However, if you have a HELOC but never use it, there's no payment obligations. Essentially, if it remains untouched, no interest accrues. It stands as a readily available reserve of funds, poised for deployment at your discretion. Should you decide to tap into it, no further approval from the bank is required. In essence, a HELOC offers flexibility, potential tax benefits, and access to funds when you need them. But it's crucial to remember that it's borrowed money that must be repaid with your home as collateral. Before diving into a HELOC, it's important to assess your financial stability, long-term plans, and the current market conditions. History of HELOCs. Now let's take a brief journey back in time to understand how HELOCs came to be a popular financial tool today. The concept of borrowing against the value of one's home isn't new, but the structured HELOC began gaining prominence in the early 1980s. During this era, deregulation in the banking industry allowed homeowners to access their home equity more freely. This was a period of innovation in consumer finance, with financial institutions developing new products to meet the growing demand for flexible, accessible credit. The 1990s and early 2000s saw a significant increase in the popularity of HELOCs. Homeowners were attracted to the idea of leveraging their home equity for renovations, education, or to consolidate debt. The appeal was clear. HELOCs provided a way to borrow at lower interest rates with potential tax benefits. However, the financial crisis of 2008 brought a tighter regulatory focus on lending practices, including HELOCs. Despite this, the resilience and utility of HELOCs have seen their use continue to evolve, adapting to changing economic conditions and homeowner needs. From a regulatory novelty to a staple of personal finance, HELOCs have a rich history that underscores their enduring value to homeowners. As we navigate the complexities of modern finance, understanding this history helps us appreciate the HELOC's place in our financial toolkit. 3 advantages of using a HELOC. With the basics and history of HELOCs under our belt, let's pivot to something a bit more uplifting: the advantages. Why have HELOCs become such a sought-after financial tool for homeowners? Here are the key benefits. First up, flexibility. A HELOC offers you a revolving line of credit, much like a credit card, but with a much larger potential limit based on your home equity. This means you have ongoing access to funds when you need them, without reapplying. Imagine the freedom to fund home renovations that increase your property's value, cover educational expenses, or even tackle unexpected medical bills, all without tapping into your emergency savings. Next, the cost advantage. Generally, HELOCs come with lower interest rates compared to credit cards and unsecured personal loans. This is because your home serves as collateral, reducing the lender's risk. And let's not forget potential tax benefits. Interest paid on a HELOC may be tax deductible if you use the funds for home improvement, adding another layer of financial benefit. However, it's crucial to consult with a tax advisor because tax rules can be complex and subject to change. An often overlooked advantage is the no usage, no interest feature. If you don't draw from your HELOC, you won't pay interest. It's a financial safety net that's there when you need it, without the cost when you don't. This is considered one of the biggest advantages when compared to regular home equity loans, because you start to pay interest on day one if you decide to take out a home equity loan against your home equity. In essence, a HELOC isn't just a loan. It's a versatile financial tool that can adapt to your changing needs, offering both potential savings and peace of mind. You can use it to leverage lower interest rates, enjoy the flexibility of a revolving credit line, or capitalize on tax advantages. The strategic use of a HELOC can be a powerful component of your financial strategy. 4. How to use a HELOC wisely. A HELOC offers tremendous financial flexibility, but with great power comes great responsibility. Let's explore how to harness this power without getting burned. First, understand your why. Before tapping into your home equity, clearly define your purpose. Is it for home improvements that increase property value, consolidating high-interest debt, or perhaps expanding your investment portfolio? A clear goal ensures your HELOC serves a strategic role in your financial health. Speaking of home improvements, this is where a HELOC shines. Renovations can boost your home's market value, making it not just a place you love, but also a smarter investment. Think energy-efficient upgrades or an additional bathroom, not just aesthetic changes. Debt consolidation is another wise use. By paying off high-interest credit cards or loans, you can reduce your overall interest payments and streamline your finances into one manageable payment. However, this requires discipline. Consolidating debt should be a step towards financial freedom, not an excuse to rack up more debt. An often overlooked yet wise use of a HELOC is as an emergency fund. Life is full of surprises, unexpected medical bills, urgent home repairs, or sudden job loss. A HELOC can provide a safety net, but it shouldn't replace cash savings. Think of it as a backup to your backup. Also, consider using a HELOC for investment opportunities that offer a return greater than the cost of borrowing. This could mean investing in the stock market, real estate, or starting a business. But remember, investing involves risks. Ensure your potential returns justify those risks and that you're not jeopardizing your home. 5. The best way to use HELOCs. Now, let's pivot to a golden opportunity for savvy investors. Using a HELOC for real estate investment strategies such as house flipping and the BRRR method. I personally think this is the best way to use HELOCs. House flipping involves purchasing properties, renovating them, and selling them at a profit, typically within a short time frame. Here's where a HELOC shines. Due to its pay-as-you-go nature, you only pay interest on the amount you draw, making it a cost-effective option compared to hard money loans, which often come with higher interest rates and points. Moreover, utilizing a HELOC allows you to make cash offers on properties. In the competitive real estate market, a cash offer can be far more appealing to sellers than one contingent on financing, giving you a significant edge. This not only speeds up the transaction, but potentially lowers the purchase price, reducing your overall investment cost. And with a HELOC, during the first 10 years, the interest-only phase, you're not burdened with principal payments, significantly lowering your carrying costs during a flip. This financial breathing room is invaluable, especially in projects with tight turnaround times. On the other hand, the BRRR strategy, buy, renovate, rent, refinance, it's another realm where a HELOC excels. Initially, you use the HELOC to fund both the purchase and the renovation. After enhancing the property's value and renting it out, the next step is to refinance it with a conventional mortgage. This refinancing not only pays back the HELOC, freeing up your credit line for the next investment, but also taps into the increased equity of your now income-producing property. It's a cyclical process that, when executed well, can significantly expand your real estate portfolio. In the landscape of financing options, a HELOC stands out for real estate investors engaging in flipping and BRRR. Its flexibility, lower borrowing costs, and interest-only payment phase offer a competitive edge unmatched by other financing methods. While the potential for profit is enticing, remember these strategies require thorough market research, a solid understanding of renovation costs, and meticulous financial planning. The beauty of using a HELOC lies not just in its flexibility, but in its potential to make each dollar work smarter, not harder. 6 risks of HELOCs. While we have covered so many positive things about HELOCs, does it come with any negatives? Of course, every coin has 2 sides. It's crucial to navigate this financial tool with eyes wide open to the risks involved. Let's peel back the curtain and examine what you need to watch out for. First and foremost, the most significant risk is putting your home on the line. Since a HELOC is secured by your home, failure to repay could lead to foreclosure. It's not just a line of credit, it's a commitment that your home backs directly. Another point of consideration is the variable interest rate. Unlike fixed-rate loans, the interest on a HELOC can increase, affecting your monthly payments and overall loan cost. Economic shifts can suddenly make your affordable loan more expensive. The temptation to overspend is a less discussed but equally real risk. With a substantial amount of money easily accessible, it can be tempting to use your HELOC for non-essential or impulsive purchases, leading to unnecessary debt that could strain your finances. Don't forget the transition from the draw period to the repayment period. After years of interest-only payments, you'll need to start repaying the principal. This shift can result in a significant increase in your monthly obligations, potentially catching you off guard if you're not prepared. Remember what Warren Buffett said, the first rule of an investment is don't lose money. And the second rule of an investment is don't forget the first rule. And that's all the rules there are. Navigating the waters of HELOCs requires a balance of leveraging their benefits while being acutely aware of the risks. It's about making informed decisions, planning for the future, and always remembering that the safety net of your home's equity should be used judiciously. 7. How to qualify for a HELOCs. So we have explained what a HELOC is, the advantages and best use, and the risks involved. If you decide it's the right product for you, how you can qualify for one. Let's break down what you need to know to get your application across the finish line. First up, equity. To qualify for a HELOC, you need sufficient equity in your home. Typically, lenders require that you have at least 15% to 20% equity. In simple terms, your home's value must exceed what you owe on your mortgage by at least 15%. If your home worth $1 million and your mortgage is $850,000, that means you only have 15% of equity with 85% of loans. The bank will probably not approve your HELOC application. Your credit score also plays a crucial role. A higher score not only improves your chances of approval, but can also secure you a lower interest rate. Most lenders look for a score of 620 or higher, but aiming for 680 or above puts you in an even better position. Income verification is next. Lenders want to ensure you have the financial stability to repay the HELOC. Be prepared to provide proof of income through pay stubs, tax returns, and possibly even bank statements. If you already have a banking relationship with them, it will make your life way easier. Debt-to-income ratio, or DTI, is another key factor. It measures your monthly debt payments against your income. Lenders typically prefer a DTI below 47%, showing you're not overly burdened by debt. Your total monthly debt divided by your monthly gross income equals your DTI. If your gross monthly income is $10,000 while your monthly recurring debt is $30,000, that will give you a DTI of 30%. Lastly, be ready for the appraisal. The lender will want an up-to-date assessment of your home's value. This step determines how much you can borrow and confirms the equity required for the HELOC. There are many factors that will affect your application on HELOC and how much the bank is willing to lend you. The more you are prepared, the better position you will be. Qualifying for a HELOC might seem daunting, but it's all about demonstrating to lenders that you're a reliable borrower with the financial health to manage additional debt responsibly. With the right preparation, you can unlock the potential of your home's equity to support your financial goals. As we draw this journey to a close, we've navigated through the intricacies of home equity lines of credit together, uncovering their potential, understanding their risks, and learning how to qualify for them. HELOCs are indeed a potent financial tool, offering both opportunities and risks. Remember, whether it's leveraging your home's equity for significant investments, consolidating debt, or funding that much-needed home renovation, a HELOC can be your ally. But like any form of credit, it demands wisdom, foresight, and a disciplined approach to ensure it serves your financial well-being, not undermines it. Now I turn to you, our valued viewers. How do you see a HELOC fitting into your financial strategy? Are there experiences or tips you'd like to share? or perhaps questions that linger in your mind? Dive into the comments section below. Your insights enrich our community, sparking conversations that lead to collective growth and understanding. If you found value in our exploration today, show us some love. Hit that like button, subscribe to our channel, and share this video with friends and family who could benefit from these insights. Your support fuels our mission to demystify finance, making it accessible and actionable for all. Keep working towards your financial goals and be kind to the others. See you in our next video.